We are back with another deal of the week breakdown, and in this video I want to show you guys exactly how my clients are continuing to purchase one primary residence every single year. This client is actually a client who's worked with us on multiple deals already. We've helped him now buy 3 properties in the span of 3 years. So it's crazy what's actually possible when you understand a structure behind scaling your real estate portfolio, as opposed to just going and dumping massive down payments. Every lender is going to tell you they have no problem with a 20% down payment, but we are going to tell you, why are you putting 20% down? And that's the biggest difference, is that I always look at my clients' deals as if it was my own, and I want to make sure that I'm giving them the best advice possible for what makes the most sense for their specific situation. Now, let's jump right into the specifics. I absolutely love this deal, especially because it's my client's 3rd property. And like I say, every single year, you want to get with my team to be able to understand what's happening with your taxes, making sure that you're actually qualifying for more financing. This client, if we had not looked at his tax returns prior to him filing them with the IRS, he would not have been able to buy this house. I just want you guys to understand that taxes become a massive piece in your ability to qualify once you already own real estate. You need to make sure that you're reviewing it with your CPA, but that you're also reviewing it with your mortgage broker to make sure that it makes sense for what you're trying to accomplish in that specific year. This property was in Smyrna, Georgia, which is in the surrounding Atlanta area in Georgia. And I have a lot of clients in Georgia that purchase a lot of real estate in Georgia. Georgia's a phenomenal market for fix and flips, investment property, long-term rentals, short-term rentals, mid-term rentals, and even a rent by the room model. I have a lot of investors that buy multifamilies, but this client purchased an additional single-family residence now that he bought as a primary residence to move into. So we ended up doing conventional financing. You guys know that I'm always talking about conventional financing. If this is your first time watching one of my deal of the week breakdowns, I preach conventional financing because it's one of the most traditional type of loan programs that people use when they're scaling their real estate portfolio, especially in the early stages of scaling your real estate portfolio. We want to try to keep things simple. Now, conventional financing actually allows you to have 3 what we consider occupancy types. Occupancy types just basically means, what are you going to be using the house for, and then telling the bank, hey, this is what we plan to do. So on conventional financing, you have 3. One is primary residence, which in this situation, it's a 5% down payment. If you're a first-time home buyer and you don't own any real estate, you can actually do a minimum of a 3% down payment. Oftentimes, I find that investors who are buying their first property will end up doing a 3% down payment. And then every year after that, if they're buying a new primary residence, then we're doing a 5% minimum down payment. The second option on a conventional loan is what's called a vacation home loan / second home loan. That allows you to get in with a minimum of a 10% down payment. That is most commonly used for my investors that are purchasing midterm rentals or short-term rentals, anything that's going to be less than a 12-month long-term lease. We want to use a vacation home loan if we can get you to qualify for it. It will save you significantly more money. And then if we can't get either of those options, or if you're buying strictly a long-term rental investment property, then the minimum down payment is 15%. And that's the third option on a conventional loan. So in this situation, we are now on year 3 of this client buying a primary residence. And in this situation, he ended up doing a 5% down payment. So that's the minimum that's needed. That's all we were going to be doing for this deal. Why are we going to put more than that if we don't have to? So client ended up buying a single family home. What's cool though too, is he could have bought a multifamily. You can buy multifamily real estate and also put 5% down if you're living in the property, which is just phenomenal now. Funny enough, those guidelines actually changed. It was a higher down payment a couple of years ago, and then they went and made significant adjustments, and now it's so much less money out of pocket. So property ended up appraising for $365,000, which is what he actually had purchased the property for. So it was $365,000. Purchase price was also $365,000. But you guys will see that we had also negotiated some money for seller credits. This was a 6,882 square foot lot. It was a 1,300 square foot living space. The property is a 4-bedroom, 2-bathroom house. He plans to do a house hack. So he wants to live in one unit. He's going to rent out the other units. It spent 64 days on the market, which is probably one of the reasons why we were able to negotiate so much money for seller credits. Now, because the minimum down payment was 5%, 5% of $36,000, this one ended up coming in at $18,250. Interest rate that we got on this deal was phenomenal. It was even before rates had started to come down. We ended up locking in at a 6.125%. Great. Principal and interest payment ended up coming in at 2106. Now, most people right now are still doing 30-year fixed. They're not really doing adjustable rate mortgages. It just doesn't really make sense. A lot of banks don't want people to do adjustable rate mortgages. It makes it more expensive for them. And banks don't want to have to deal with people refinancing right now. Granted, I have adjustable rate mortgages myself. I've had people who've gotten adjustable rate mortgages, and we do adjustable rate mortgages. It's just if the situation makes sense. We want to compare pricing. Let's compare it, see if it's better. Great. If it is, let's do it. If we know we want to refinance in 2 or 3 years, sometimes that makes sense instead of a 30-year fixed mortgage. We ended up doing 2106 here for principal and interest. Homeowners insurance came in at $148.75. Property taxes came in at $282.65. Monthly PMI came in at $132.92, which is somewhat on the lower end. And I always talk about PMI and how PMI is actually private mortgage insurance. I always look at it as the cost of doing business, where you're going to be spending this money monthly in order for the bank to let you put less than 20% down. And in this example, it's like, why would we come in with an extra 15% down to save the $130 a month? Another 15% down on this is going to be like $45,000, $50,000 that this client's bringing to the table. Why are we going to put that money into the deal if we don't have to, right? Like, that's always my perspective. If it doesn't make sense and we don't have to come in with extra cash, let's not even waste our money on doing that just to save $100 a month. Go save that money, put it towards your next property. Because in the same example, that extra 15% could have been used for a second deal next year, as opposed to just putting it into this property, only getting one house. Doesn't make sense. If you can do more with your money, don't put it into that deal. That's why I will challenge my investors in saying, why are you putting 20% down? Some people want to put 20% down just to feel good and not have to have PMI, when if we actually look at the numbers, it typically makes sense to just take the PMI and then refinance in 2 years, and you'll have an increase in value where you can now remove PMI. So something to think about. It's very important to kind of talk through those things. People also think that interest rates are fixed and like you can't change things. Well, you pretty much have up until like the week before you close on a house to be able to change around all your numbers. If you want to come in with a bigger down payment, if you want to get another insurance policy, if you want to remove PMI, if you want to buy down the interest rate, there's so many things that we can do, and we have flexibility until the loan paperwork is signed on the very last day. Like, nothing really changes. You have the ability to make a lot of changes up until that point. Total monthly payment on this ended up coming in at $26.71 with 21 cents. So $2,600. Even if he rents one side at $1,200, 1 bedroom or 2 bedrooms at $1,400, he's still going to be paying less than what he was paying before. And now his previous house turned into a rental that's cash flowing. So it's kind of a no-brainer. If you're picking properties that hey, next year I'm going to move out, but I'm saving money on the out-of-pocket right now, it's the easiest way to get into a deal. Total closing costs were at $24,812 with 93 cents. We got seller credits of $9,000. Adjustments and other credits of $1,384 with 58. And then total out-of-pocket on this came in at $32,678. So back to my example, if this client had said, I want to put 20% down, Ricardo, and we calculated him coming in at 20% down or at 15% down, that 20% down would cost him 70 grand. And then he would have been able to be dividing that into 2 properties, right? Like, if he's dropping $32,000 on this deal and $32,000 next year on another property, he now got 2 properties for the price of one, as opposed to having to come in at 20% down. So I challenge you guys to think differently when it comes to looking at the numbers and seeing how can we save more money up front, because once you put that money into the deal, it's going to be a lot harder to get that money out. And so if we don't even put it in there in the first place, then saves you the money and it helps you scale your real estate portfolio. My team and I are always helping our clients analyzing deals just like this, where we walk through all of the numbers and make sure that the deal makes sense for what you're wanting to do over the long term. And like I also mentioned at the beginning of this video, it's extremely important in order to make sure your taxes are being reviewed for your qualifying ability. If you know you want to buy real estate in that year, make sure that you're running it through a professional who understands what they're doing and looking at those deals and telling you, hey, you need to make some adjustments on this, or no, you're great, let's file your taxes and let's move it forward. So we're going to continue to provide you guys with what our clients are doing and how they're buying real estate and how their real estate investing is going and how they're scaling their real estate portfolios while keeping their money out of pocket significantly lower. And if you guys want to do this exact same thing, if you need help in figuring out, what market should I be looking at, what realtor should I be working with, my team has all of the resources at our disposal in order to guide our clients through the entire process. We are advisors and we want to make sure that our clients understand exactly what they're getting themselves into and that we're putting them up into a deal that's going to be setting them up for success. So over the long run, That's what we're here for. We want to work with our clients to make sure that we're building their wealth through real estate, and we're going to take you through it one deal at a time. I will see you guys in the next deal of the week breakdown. Job is not finished. Let's make it happen.